So I'm thinking if they let us keep doing this long enough, I forget what episode we're on, call it 15. For the 50th episode, you have coffee with me. Do it for the audience, man.
I don't think the audience can care less. I think the audience wants me to be myself.
Oh my gosh. Jesus. Boring.
Listen, I got enough things to worry about in my life than trying to appease you.
Well, appease. Jesus, dude. You like took it personally. I'm asking you to have a coffee for the 50th episode. No, I think it'd be fun, man.
Don't like coffee.
Dude, you've never tried it.
Yeah, I'm not a fan of warm drinks. We've gone over this before. See, last episode of TY.
Brett, temperature aside, just have a little shot of Cuban coffee, man. It's part of my culture, so it's important to me. Oh, that's right. Where's your wife from again?
Cuba.
Okay, good. So 50th episode it is.
Welcome, everybody. Talk Your Chart, episode 16. Brett Horowitz here with Marco Segrera. Last time we finished up talking about interest-paying bonds and sort of the difference between how sometimes you see a bond fund with a loss from a tax perspective, but it really has a performance gain. And today we're going to talk about dividend-paying stocks, something that is, I think, to me, a very similar concept, but one that really confuses people.
You're a myth buster. You're going to break a lot of hearts today, Brett. You're going to break a lot of hearts.
Yeah. So I think the easiest example to think about is stocks oftentimes pay a dividend, once a quarter. And oftentimes when that dividend comes, I think people think that is an event where there's a free return. And I make the analogy, it's sort of like you showing up for payday on Friday. We get paid twice a month, and being like, okay, I'm showing up one day a week. Where's my paycheck? It doesn't work that way. It's not free money. So I'm starting here with a little chart and a little example of a stock at $55 a share. Someone owns 1,000 shares for $55,000 investment, and the dividend is paying out at $5 for the quarter. And so that's a 9% dividend yield. And so the day after that stock—
Is this a real stock? Is this a real stock, or you made this up?
Made it up. Just to use easy numbers.
9% is a thick dividend. I like it.
Yeah, it's called a utility company or—
Oh, no, that's like a REIT that's beaten up. That's what that is.
Okay. So yeah, probably too high to be a real stock, but it's just so as the example.
Okay, I'll allow it.
So one of the things that you have to be aware of, and we get asked this question a lot with clients, is the day after a stock declares a dividend, the stock price drops. Why is that? Because when they give you a dividend of cash, you can either choose to take that cash and keep it in your pocket, or reinvest that cash in more shares. But effectively, that cash or those shares has to offset the fact that the price went down.
Sure.
Because again, this is not a free event. You can't just buy every stock the day before the dividend date and make a ton of money. So I gave 3 different examples here of what an investor could do. Investor A could take the cash, and so they have the same number of shares, but with a lower price, and now they have cash on the sideline. Investor B could reinvest the dividend. They've got now more shares at a lower price, and so they've got the same $55,000 value. Or investor C could then decide if this stock didn't have a dividend and they wanted to basically recreate a dividend, effectively give themselves the same $5,000, they could sell basically 91 shares.
Okay.
The stock price is still at $55 because it hasn't issued a dividend. They now have $5,000 in cash, and so they're back to the same point.
And this investor C, you're using this simply as an example to make the point that selling shares is ultimately going to be the same thing as receiving a dividend. Obviously, investor C, there's no dividend whatsoever, but they could create their own dividend by selling a number of shares equivalent to the amount of the dividend they missed out on.
Right, exactly. So how many clients come to us and say, hey, I love these stocks that pay a dividend? And the point here is that you can create your own dividend, basically, by selling a little bit every quarter or every time the dividend would have paid out, and having the same cash flow as a stock that paid out its dividend.
Okay. So what's the best way, in your opinion, I have my opinion, what's the best way to view dividend paying stocks or dividend as part of a total return strategy, I guess?
Exactly. So I wrote an article a few years ago called Myth Busting Dividends. And basically, the point that I'm trying to make in this article is that, as we see here, dividends are not a free return. In fact, they're not a guaranteed return either. We've seen lots of companies over the years cut their dividends. And I think also investors and clients seem to think that the higher the dividend, the more attractive the stock, right? This stock pays a 10% dividend. That's great. That's double this stock in our example. It pays a 5% dividend. Well, you know what, Marcos? If this stock drops in half from $50 a share to $25, what does that dividend do? It goes up. It doubles.
Yeah.
So, and the fact is, not every company pays a dividend. I'd much rather have a stock that makes 20% in the year in return than a stock that goes up 3% and pays a 5% dividend.
Yeah.
Right?
Oh, let me ask you a question. I thought of this. What about, oh, I know your answer. Tax. So if you sold, so let's assume there's no transaction fees, right? Because that's all free now. From a tax perspective, you're comparing a capital gain here to a dividend. I guess depending on the dividend, it could be qualified or non-qualified. So I guess it's kind of apples to apples also from a tax standpoint.
Yeah, I mean, as long as you held the stock more than a year and you're getting long-term capital gain treatment, and as long as the dividend is qualified, most dividends are, unless it's from an unusual company or a foreign corporation or so forth. But in most cases, you're at the same tax rate for both situations.
Okay. So is this just hating on dividend investors? If you're at a dinner party and you're hearing people talking about, well, yeah, I'm a dividend investor, high dividends, what I look for.
Well, I think it's not a complete picture, right? I mean, I don't think I want to be only playing in the lake that just has dividend paying stocks. I want to be playing in the lake that has all stocks, because some stocks can be really good. They just don't pay a dividend.
Got it.
And so I think that people maybe overestimate how well or how important dividends can be in stocks. I mean, clearly stock paying companies or dividend paying companies are ones that are mature. They've been around a while. They have cash flow.
Quality.
Right?
It's a quality factor.
Yeah.
There's a correlation between dividend paying and quality. There's papers on that. And that's what I was going to get to. The reason you love dividend paying stocks, or people love dividend paying stocks, is because they lean blue chip, right? There's a long standing story from Great Depression times to now about the blue chips and the stalwarts. And usually it's those quality, healthy balance sheet companies that pay cash because their internal growth rates are not as compelling as a new technology company that's like high flying. Those don't pay dividends, but they're going to compound your capital at a much higher rate or go out of business, right? But it's a quality factor that you usually end up seeing with dividend paying stocks.
Yeah, I mean, it makes sense. I understand why people own them, and there's fine. We have lots of dividend paying stocks in our portfolio, but it's not the be all and end all of everything. And it's not, as I said before, free money. So it's not just the fact that it pays a dividend is what's getting you return. And the other one concept that we talked about is that when you look at stock returns, if you do not factor in the dividends and just look at the stock price, that price is going down in this example, from $55 to $50. So you've got to add in dividends, which is why they say, the S&P with dividends or the S&P without, you've got to have the dividends included.
Total return. Yeah, you got to look at total return, capital appreciation, and whatever the heck it pays out. Okay, this is helpful.
What else is next?
My topic and I did it again. I have 3 charts. I'm breaking our own rules. I'm going recession. Why? Because obviously that's every single headline, boom, big, bold, recession watch. Every CNBC thing, everything's red. The market's down today for this. It's up because that. Bond yields do this, bond yields go that. I'm going to list, how many do I have? I have 6 things here that everyone's worried about for good reason. The Federal Reserve attempting a soft landing, which is basically saying we have easy monetary policy. Now we need to tighten. So what do? They raise interest rates. They're trying to engineer that quote unquote soft landing, which has only been successful 3 times over the past 60 years or whatever that is. A spike in oil prices that's usually linked to recession, inflation at 50-year highs, the yield curve inverted, the obvious geopolitical risks, Russia, Ukraine, food shortages that are most likely going to basically rise to the surface in a lot of at-risk countries. And that's just a short list of stuff that people are worried about. And of course, everyone is now thinking recession. That's what headlines are telling you. What's interesting is if you also look at the Michigan survey of consumer sentiment, that's fallen off the cliff What's interesting about that is that's a contrarian indicator. And usually when that is low, it's time to buy.
Yeah, but I've read a couple of conflicting things. I saw yesterday, I think the credit card companies reported earnings,
Yeah.
Visa and MasterCard and others, and they said credit card balances were as high as they were pre-pandemic. In other words, people are still spending. So they were
Oh,
making the case,
absolutely.
why is sentiment so low and people keep spending? I'd also say that all the things that you mentioned that could be a risk, and we
Yes.
say could in quotation marks because oftentimes investors worry about everything, and most of those things don't end up happening. But all those things you mentioned are all things that all of us know already, right? So if you're an investor and you're saying these things could happen in the future, you don't wait for them to happen to sell, you sell ahead of time, right? So I think what I would say is I think the market is probably baked in a lot of these things already, which is why bonds are down, which is why stocks are down.
I agree without a doubt. There's something priced in. How much of it is priced in? And what I think everyone would immediately point to is, well, look at the US market. It's down what, maybe 8%. We did correct from January to March 8th. We had a 13% drawdown. So we got correction. But since then, we've basically just been treading water and are down around 8%. So have the markets held up too well for what's actually happening? And those are going to be a big repricing that comes. Who knows? But I'm going to give you here 4 points that I have to counter those other kind of negative points, which is, this is kind of piggybacking off you. There's still about $3 trillion of excess liquidity in the markets. So people are still spending now. That sentiment survey is a forward-looking metric. So people are talking about not right now, but looking forward, how do you feel about what's going on, right? The second piece is there's been talk about the Fed put, meaning the Fed had all this money printing, don't fight the Fed, don't fight the Fed. That is clearly going away as rates rise and they stop buying bonds, mortgage bonds and treasury bonds. What you now are perhaps going to get is what Ed Yardeni is calling the CFO put, where you get companies or corporations flush with cash doing buybacks, dividends, right? And a bunch of M&A activity. So there's a CFO put that's perhaps going to be helping kind of keep the market afloat. Why is the US looking good right now also relative to global markets? Well, ultimately, because we look good relative to the economies outside of the US. So there could be this kind of, remember Tina, there is no alternative. Well, there is no alternative country, perhaps. So maybe US equities are going to be buoyed because we look good on a relative basis.
Well, maybe we're only down 8% because we've had 11 straight months of $400,000 gains for jobs. Maybe we look good because everybody wants a job, can easily find a job.
I agree.
Maybe we look
but
good because interest rates are low.
Counterpoint, what's the unemployment rate right now?
3.6, no?
Yeah, I think it's lower than that, but let's forget it. It's what it basically is. It's at an absolute low, right? It's a historical low. And what usually happens right around historical lows? You get a recession because that's what happens, right?
You also have an incredibly low amount of labor participation, right? A lot of people retired, left the workforce because of COVID.
Yes.
Couldn't find anyone to raise their kids because daycare is closed. So if you can get a rise in people coming back to labor force, that'll eat into a lot of those jobs and keep the unemployment rate low.
But there's a massive skills gap. Yeah. So the labor participation rate, which was at 67, is now like at 62 or 63, something like that. So yeah, that's a big deal. But I don't know how you get those bodies back because the silver tsunami of baby boomers is leaving. Millennials and Gen Zers don't want to work factory floors because they don't feel fulfilled. So there has to be a total rebranding of all those types of jobs. And then the skill gap has to be metered out and fixed. Ultimately, we innovate our way out of this. Here, so bring it to the charts. I have 3 charts. The first one here, real quick, is you can get corrections in the market that are non-recessionary. So I'm by no ways am I saying we're not going to get a recession. I have no idea, right? But it is possible to get correction in markets without a recession. Here's a laundry list of that happening between 1950 to 2018. The other chart that I have here looks at performance around recessions. So this is just looking at the S&P 500, performance during recessions from 1945 to the great financial crisis. COVID is not included, but we know how that kind of turned out. So what this shows you here is throughout a recession, on average, markets are still positive throughout all of that.
Yeah, but I would take offense to this because I would bet that in most of these scenarios, you had big losses just prior to the recession.
Well,
Right.
of course. And that's usually what happens. There's pain that comes 6 to 3 months before an actual recession, because also you have to call a recession after the fact.
Right.
Right. It's
Yeah, you need
all
two
lagging.
negative.
The market is the leading indicator. The actual unemployment figures and recession being called is a lagging indicator, because you only know you're in a recession after the fact. So if we're already in a recession, which that I don't believe we are, given what consumers are doing, it's going to be too late anyway. But ultimately what I'm trying to get to, and this is the biggest point, when someone comes up to me, and this is client focused, this is friend focused. Hey, you know what? It looks horrible what's coming ahead. I want to sidestep it. I'm going to get out, then wait for the pain to come at some point, because it really looks like it's going to, and then I'm going to get back in. You've had those conversations, Brett, who knows how many times. I've had them a ton. And here's where I want to refocus it. We could always talk about, you got to get it right twice, on the way down, then on the way back up. What if the market runs away from you? And then, yeah, sure, maybe it falls 30% 12 months from now. But what if 30% down from 12 months from now is only prices from 6 months from today, right? So wait, you're still buying in at a higher price? How do you feel about that? Or you're saying, no, trust me, when the market's down 50%, that's when I'm going to get aggressive. Understand. So you're worried now, but when the headlines are even worse and people are calling for the world to come to an end, that's when you're going to be risk on. Okay, we'll see how that goes.
Well, it'd be easy if there was a V every time the market went down.
Well,
right?
of course, but
There's
you remember
V's turn into W's, V's turn into L's, V's turn into two W's in a row. Like, it's not like it just goes down and then goes right back up.
I feel like I'm talking to my 2-year-old, dude. Your alphabet knowledge is crazy good.
No, you're right. And I think that we're not seeing, if the smart money is selling now, they're selling now because of all the reasons that you gave. And the market is down now ahead of all those things that could go wrong. So that, again, we talked about this before, expectations. If things happen as people expect, market's not going to react because everyone thought this would happen already. It was
Exactly.
accounted for.
But so I think here's the biggest point, that, look, if you're a trader, if you're managing a hedge fund, if you're in one of these esoteric spaces where you're trying to benefit or make money off volatility, this is probably not the group of people to talk to, so to speak. But for people who are trying to invest thoughtfully, long-term, build portfolios that are resilient and built to last and are supposed to be around for as long as you are, I think the most important thing to realize is that the risk to you is not that you're going to participate in the next 10 to 50% market decline. It's that you need to be sure you don't miss out on the next 100 to 500% advance in markets, because those things come, they come fast, they come quick. They don't wait for headlines to get pretty and rosy. And when they happen, you miss out, and there's no buying back what you missed out on. And this last chart shows that. And it basically just gives you this idea of the magnitude and the difference between bear markets and bull markets. Yes, it stinks to participate in bear markets. You feel stupid being the one participating while the market's down, and that buddy that you golf with is saying, oh yeah, I took the cash a little bit, I'm now sitting in cash, so I'm going to feel real good and find an entry point and all this fancy stuff. It's okay. Timing markets, probabilistically, bad idea. Thankfully, to be a successful investor, you don't have to do it. And just appreciate what this chart is communicating to you, to me, to Brett, to everyone who's this kind of quote unquote long-term boring investor. You don't have to worry about, again, assuming we can all keep one point of faith, which is that markets will recover and capitalism worse. Shout out Steve Foldis. You need to worry about participating in the real big run-ups, not participating in the 10 to 50% drawdowns. And that is the only point I want to make.
Well said. Good charts. Thank you. Well, hopefully these things don't happen as we worry about them.
I know, man, but they come. We don't know when, we don't know how, we don't know why. But given discipline, shout out Jason Zweig again, discipline, the best thing to invest in 2022. You should end up okay.
Well, we're there to help our clients out. So
always are.
until
Brett,
next time.
see you, man.